estate to real estate. It's Money Matters with Dino.
So going back to this mentality of hard money, though, what people are so afraid of is, again, if they miss a payment, they think they're going to lose their house. Explain what happens if somebody's a little late on a payment. I mean, do you come down on him hard with a hammer? What or do you just tell Jeremy to go keep bugging him until they make a payment? I mean, how does it work? Because a Bank of America, Wells Fargo has procedures that they do, and everybody kind of knows how to play that game. And I've explained to a lot of my clients that it's not like the old days anymore. I mean, so many savvy investors such as yourself, they treat this like a business. It's not an individual that he's going to send to your house to make sure that you collect. Jeremy or whoever wants to take this one, how is that handled?
That's where my job comes in. My job is the beginning of the process and to see it all the way to the end. And so after we've underwritten it, for example, right now Jeff has 110 notes out there. He's had maybe 5 or less foreclosures. So first of all, if you're doing your job right, you shouldn't get in that situation. These are business-minded customers. These aren't consumer-needed customers that we're helping out in this private money aspect. Assuming we get to foreclosure, we usually install a servicing company. So first and foremost, letters, just like regular legal, goes out. However, if there isn't a servicing company involved, that's where it's my job at first to correspond with them. Go back to them and say, hey, what's going on? What's happened? And then obviously vocalize the concern to Jeff at that point. And then I leave it in Jeff's hands to tell me what to do. Either he tells me to fly out to a place and finish the foreclosure, or he tells me, hey, let's work with them. This is what I'm willing to do. It could be, let's put the property for sale. I'll default or defer all the payments and work with the homeowner or the borrower, excuse me. And or it's, hey, we've given him time and time again and he keeps missing his payments. At this point, we need to just proceed and move on. And so that's really his decision, but I'm there to seek that decision's made and done all the way to the end. And he sees 100% of his investment back.
To pick up on that, Jeremy's right. I've got approximately, at this time, I think I have 80 open loans right now. Since I've started this about 3 years ago, I've probably done 130 loans. Out of those, I've had to foreclose 6 times. What my legal right is, if they are 31 days late, I can't foreclose on them.
You can foreclose, or you can start the foreclosure process.
I can start the foreclosure process, which is foreclosing.
And they can, but they can correct that at that point.
That's right. In a non-judicial state like Arizona or California, they both work very similarly. The foreclosure process essentially works like this. If they're 31 days late, I can foreclose. I don't foreclose that quickly. I might wait until they're 2 or 3 payments late and showing no signs of wanting to bring the loan current. Mm-hmm. Once I foreclose, I use a servicing company. I just basically send them a fee, and they start the foreclosure process. The borrower then has 90 days to cure the default, to bring the loan current.
Sure.
Okay. During that period of time, the loan is now in default. So according to the contract, the terms of our contract, according to the terms of the note, the loan accelerates up to 24% interest. That is the default rate.
Got it.
That occurs when the note goes into default. So the borrower now has a very strong incentive to get caught up on this, because whatever their rate was, maybe it was 12, 13, 14, 15%, now it's 24%.
Now, is that all built into your contract when you first give the loan?
Yes.
Okay, so
yes.
It has to be specifically spelled out at the very beginning.
That's correct. It's contained within the language of the note.
Okay.
Additionally, what's contained in the language is a 15% late fee. So anytime the payment is received after the 10th of the month, there's a 15% of the payment amount fee that gets added. So here is the borrower now not making his payments. His loan is now all of a sudden not 14%, let's say, it's 24%.
Yep.
And he's being exposed to these late fees, which is 15% of the new payment.
Yep.
So this gets pretty expensive. What most borrowers will do in this case is they will elect to sell the property on their own and de-lever themselves and pay me off.
Right.
Now, your listeners may be wondering what's happening to this 24% interest and all these fees. During the foreclosure process, they're typically not making payments. They're usually trying to figure out what they're going to do. What happens is, after 90 days, the property will get seized by the county, by the sheriff usually, depending on the area. And then subsequent to that, within about 3 weeks, it gets put into a local auction where investors bid on this foreclosed property. So an investor will buy the property, and me as the lender will get paid off. Well, first the past due taxes get paid. Then me as the first position lender will get paid my principal and all my past due fees and interest.